Welcome to the Bloomberg Daybreak Asia podcast. I'm Doug Krisner. Markets in Asia came online today to news of a big sell-off in the U.S. We had the S&P 500 suffering a loss of 3%. That after the Fed reduced the number of expected rate cuts next year by half. In a moment, we'll be talking with Pat Kennedy. He is founding partner at AllSource Investment Management. But we'll begin in Singapore, where we find Paul Dobson, Bloomberg Executive Editor for Markets in Asia. He joins us from our studios in the Lion City. Paul, thanks for taking time to chat with us. It's got to be a big shock, I'm sure. A big spike in yields, much stronger dollar, and the dollar story alone has to be spelling trouble for markets in Asia.
Yeah, hi there. Certainly this doesn't look very positive for Asia's markets on the round because they're so negatively correlated to the dollar. So, after the Fed, we had that big push higher in US yields that supported the dollar right across the board. And for Asian currencies that were trading or currencies from our time zone that were trading in those hours, it was a pretty swift move lower. The New Zealand dollar, the Australian dollar, for example, under pressure. And we're starting to see that as we get markets opening up now in our region. The Korean won fell a long way at the open, the weakest level in decades there, and right across the board, what we're going to see now is how various central banks are going to respond to it. Are they going to try and intervene and resist it, or are they going to tolerate further weakness against the dollar if it's all falling in tandem?
Well, speaking of weakness, the Japanese yen was down in New York, trading by around 0.9%. We're trading at just under 155 against the greenback. This takes us to the BOJ, which has a policy decision at the end of the week. Is the feeling still that BOJ is going to kind of sit on its hands?
So it's an interesting one, isn't it? Like you said, with the yen at 155 and under weakening pressure, the BOJ has a pretty clear path if it wants to raise interest rates as soon as this week in order to give the currency a little bit of support. And yet, having given us a sort of indication that might be where it was leaning, as recently as sort of like a month ago, it then sort of pivoted and the communication seemed to push back against the idea that there would be a hike this year. And so now market is trying to work out whether it's January would be the right month or even a hold until March in order to be more certain that wage inflation is still entrenched. Now, people will be thinking, on the other hand, why do they need to wait so long? Why not get on with it? Well, while the opportunity is there, they don't want to unsettle the bonds market. They don't want to stop inflation from budding in Japan. But at the same time, a hold and some signal that they're in no hurry to move now may push the yen through that 155 level and see it continuing to weaken to fresh lows against the dollar.
But I would imagine it's quite the opposite when you consider the People's Bank of China, because of the weakness in the offshore yuan and onshore as well. Is that the right way to think about this? I mean, the PBOC would allow the yuan to weaken to help with the export economy?
It doesn't seem in any particular hurry to do it. The UN is trading with a weakening bias. And certainly if Donald Trump does come in and start to impose those tariffs, then the market calculus is that the PBOC will allow the UN to weaken to offset the impact of that on the Chinese economy and on Chinese exporters. On the other hand, what it doesn't want is a sharp depreciation in the UN that encourages more outflows from the currency. So it's playing that sort of delicate balancing act, a little bit of a tightrope where, yes, the general direction seems to be to allow it to weaken, but no sort of strong or knee-jerk kind of moves. More a sort of steady pace would be the way to see it.
Generally speaking, if you look at the reaction in markets to what we've been hearing from the Politburo, some of the official messaging as it relates to future policy, how would you characterize this? Are people cautiously optimistic?
Yeah, Doug, I think people are just so skeptical because we've been promised so much and the delivery has been underwhelming for the most part. You know, what everybody in markets would really love to see would be some kind of huge big bang with a lot of policy enactments all at once. But instead, it's more of a piecemeal approach where there's incremental pieces of stimulus being announced and put into place. Of course, that requires patience, and financial markets aren't really patient. So when we did finally get a little bit of a sense sense that there was something coming together. We had that big boom higher in the equities markets at the start of the fourth quarter. But since then, the enthusiasm has died off somewhat. And while, the market might view the Chinese authorities as being more minded to stimulate growth, to stimulate the economy, to borrow in order to fuel growth, the exact mechanisms and way that that's going to play out are still a little bit unclear. And until there's more policy clarity, yes, there could be, an underlying sense of perhaps we're headed in the right direction, but there's still that sort of unwillingness to commit too much on hope rather than, kind of firm evidence of what's coming.
And then you look at what we had in the last week, the retail sales data, which was shockingly weak. And that just kind of goes to the point, does it not?
The need to get consumption going again. And there is bits and bobs going on, working through some of the property market difficulties and helping out there. Consumption vouchers, that kind of thing seems to be very popular. They have that trade-in policy where people can exchange some of their electronic goods, the sort of cash for clunkers equivalent in China, for new products with a discount. But for all of that, it's the same as with the markets in a way. The consumer is still skeptical and unwilling to spend too much either.
Paul, we'll leave it there. Thanks so much for taking the time to chat with us. Paul Dobson is Bloomberg Executive Editor for Asia Markets, joining from Singapore here on the Daybreak Asia podcast. Welcome back to the Bloomberg Daybreak Asia podcast. I'm Doug Krisner. So the final Fed meeting of the year is now history. We got that 25 basis point rate cut, as markets had expected. But the bigger surprise was the outlook for rate cuts in the new year. For a closer look, we are joined by Pat Kennedy. He's founding partner of AllSource Investment Management. Pat, thanks for making time to chat with us. If you're looking at what the Fed is now implying at this point in time, and what the market had been thinking in terms of rate cuts for the new year, that's a big disconnect, right? And it no doubt explains today's sell-off.
It does, Doug, but to me, it wasn't too much of a surprise. I think last time I was on, we had talked about some risks that we had saw to 2025, and we see inflation very much in the forefront still. We don't think it's something that's gone away yet. If you look back at the 70s, when the Fed fought inflation last, this bullwhip effect where, they'd raise rates, inflation would go away. As soon as they started cutting, inflation would come roaring back, right? And I'm not saying it's exactly a repeat this time, but history does rhyme. So this was something that we were concerned about. I think that what Powell communicated today, at least most institutional investors I speak with, it was no big surprise, right? So, the economy's hanging in there. We have CEO confidence raising, you have consumer confidence raising. You have lower regulation next year. M&A is expected to pick up. Why would they cut is the question. So I think going from 4 to 2 is not that big of a secret. And to be honest, I was surprised at the price action afterwards because to me, it wasn't much of a headline.
We need to tease out what he said about some members of the committee expressing maybe a little greater uncertainty about disinflation. If you look at what we're hearing in terms of economic policies from the incoming Trump administration, do you think that is worrying the Fed a great deal?
I think that the Fed doesn't want to mess up their soft landing. I think Jerome Powell now sees a soft landing as a real possibility. We're in it, right? And I think that it's time to kind of take the training wheels off and see if this economy can stand on its own. So I think they're in the process of doing that, and I think they want to do it very delicately. I don't think they want to go down as the Fed that let the inflation genie back out of the bottle. And again, if you go back to, the last time in history this happened in the 70s, as soon as the Fed started cutting, inflation came roaring back. It wasn't until Volcker came in and truly stomped inflation out and kept rates very high for a long time that it truly went away. So I think the Fed doesn't want to be known as the Fed to go down in history that let the inflation genie back out of the bottle.
But when you hear things about the possibility of tariffs sometime next year or tax cuts being extended that haven't necessarily been funded and the risk to maybe inflation in that environment, does that create a little bit of concern for you?
For me, it does. I look more at the national debt at this point. I think that's kind of the 900-pound gorilla in the room that most people aren't talking about. You got a $5 trillion debt service, $2 trillion deficit, and $35 trillion debt. we're getting to the point where it's getting out of control, right? So you had Druckenmiller talking about this a while ago. Folks like Paul Tudor Jones are now saying that the chickens come home to roost. We now need to start paying attention to this. And I think if we continue to put it off, it's going to become such a problem where we're going to have to face it. And if we get to that point, it's not going to be a pretty picture.
So what's your outlook for the equity market in the year ahead?
So, we look at strategists and, most people are predicting somewhere on the S&P range from 6,500 to 7,000. We think it's going to be a decent year. You have M&A expected to pick up. We're seeing that in private equity markets, by the way. We're starting to see private equity managers call down capital again and things of that nature. We're also seeing deregulation, well, at least rumors that deregulation is going to pick up in a big way. So we think that's pretty bullish. With that being said, we're still cautious on some things next year, right? I think we just hit on one, inflation and potential for the Fed to change course. To be honest, I wouldn't be surprised at all if the Fed comes out within the next 12 months and puts a cut on the table, or excuse me, a hike on the table.
Wow.
And the reason why is, look where we've come from, right? 6 cuts to 4, now to 2. If we have tons of spending that goes on next year and inflation starts really ramping back up, it wouldn't surprise me in the least to see the Fed come out and say, hey, we need to hike, right? At that point, all they would need to do is just hint at it and markets would price it in. So we view that as a big risk. The other big risk that we see that could potentially play out that we're paying real close attention to is AI monetization. So, the AI train has been running for a while now. We've seen the benefits of it in names like NVIDIA. Some of the software names are starting to really pop now too. And you trust me, we've been beneficiaries of that through our stock managers and so on. But we now are at the point where I think the market needs to see results when it comes to earnings. So earnings are expected to grow mid-teens next year. Profit margins are expected to expand about mid-teens as well. I think a lot of that is based on AI and what AI can do. If we start to see a miss in that, that's going to be a real risk to the market. So those are kind of the 2 big things that we're looking at. Well, 3, the Fed changing course, inflation, and then AI monetization. That could potentially throw off what we think will be a decent year based on deregulation and M&A picking up.
So, Pat, I'm curious about where you're finding opportunities in the equity market right now. We talked a moment ago about the sell-off today, not just in the broader market, but I was struck by the fact that small cap shares were especially hard hit. So there seems to be a concern in markets now that, yes, the economy may be downshifting a little bit under the weight of higher rates. And as the Fed recalculates the notion of aggressive rate cuts in the new year, it seems like the stocks that are more exposed to the domestic economy are now a lot more vulnerable.
You bring up a really good point, Doug. So we think it will be a stock picker's market next year. So we do think it will be a decent year for the index as a whole. But we think that fundamentals are still really going to matter, right? It's not going to be one of these environments where there's excessive cutting going on and it kind of raises all boats with the tide. We think that, Powell's going to be very cautious as he cuts, just as he said today. And because of that, we're going to be in a higher rate environment than anticipated. In that sort of environment, fundamentals are extremely important, which is one of the reasons why we prefer active management over passive management. We think active managers, things like hedge funds, could have a really big year next year. In fact, BlackRock did a study basically going back to 1994. And they took a look at when rates were below 2% and above 2%, and then took a look at hedge fund performance, right? So when rates were above 2%, hedge funds performed at about 12% per annum. When rates were below 2%, hedge funds did about 5% per annum, right? So it just shows you that when rates are higher, as Warren Buffett says, it's kind of gravity for asset prices. And that's a stock picker's heaven right there, which is one of the reasons why we're getting more exposure to hedge funds and active management going into next year.
So away from the equity market, when you look at fixed income, are you finding opportunities in corporates?
Because we're concerned about inflation still, we're really not doing anything too fancy within fixed income. Our fixed income bucket, being a heavy alternative manager, is more so things like, again, hedge funds, private equity, private credit is a big thing in our portfolios. We still like gold and commodities a lot. We think gold will be a great hedge going forward. Bitcoin, we don't own it in a big way. We're not, extremely exposed to it, but we are bullish on it. So we're starting to see institutional adoption there, and we could see prices go higher. We have some client-specific positions, which is why we monitor the asset class. But yeah, we anticipate Bitcoin, gold, commodities all to run higher if inflation stays a bit hotter.
So we've talked a lot about the U.S. I'm curious, Pat, whether you're seeing opportunities offshore these days, whether it's Europe or Asia. Is there anything there?
Yeah, great question, Doug. So, our long-term stance on China. We kind of say date it, don't marry it, right? But we have been seeing some really good trading opportunities in China around the headlines. So, as a new round of stimulus is anticipated and that sort of thing, you see a lot of great momentum take place. We're playing that more in the short term. Through names like K-Web and that sort of thing, rather than locking in for long-term investments. But we do see some trades there in the next, call it 3 to 6 months.
Pat, we'll leave it there. It's always a pleasure. Thanks for joining us today, and all the best for the year ahead. Pat Kennedy is founding partner at AllSource Investment Management, joining us from Hartford, Connecticut, here on the Daybreak Asia podcast. Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.